Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the monthly movers and shakers show where we try to ascertain whether the big trends within the FX, indices, and commodities space are going to continue or reverse. So let's get into it. First and foremost, this is the breakdown for the performance of some of the major FX currencies. Notably, these are FX indices, so trading against a basket of currencies. And you can see that it's the New Zealand dollar, which has won out. That's notable given the fact that we have got an expectation that we're going to see the RBNZ cutting rates this month, being September. But nonetheless, the RBNZ, alongside the Federal Reserve, have rates that are over and above that seen elsewhere. And so, when you're looking at the RBNZ with a headline interest rate of 5.25, matching the Federal Reserve, that's above the Bank of England, the Bank of Canada, Australia, the ECB, the SMB, the BOJ, all of them. So that could be playing into it. There could be a feeling of potential optimism around what's happening in China. That being said, we've just kicked off September with the latest manufacturing PMI out of China, and that moved towards the downside. So not necessarily moving on that front. But there's a big question mark as to whether the gains that we're seeing at the moment are justified or not. Now, it's worthwhile also noting that a lot of this is being driven by what's happening with the US dollar. And the US dollar is at the bottom of the pile here, in part because of the fact that we have seen these big question marks arising around the US jobs market, around a potential for a recession. It points towards further easing and more rapid easing from the Federal Reserve. And so people start moving towards other assets. They might think, well, we're moving into a period of monetary easing. It should be good for equity markets. The desire for these haven assets is minimized. And on the flip side, we're seeing the likes of the Japanese yen coming back into play in terms of strength. And so people have other assets to get onto if they're looking for some sort of haven asset. So you've seen the likes of the Swissy, you've seen the likes of the Japanese yen, both gaining ground against the US dollar, which found itself at the bottom of the pack. So let's look at the US dollar against the Kiwi, and we can see here that it has been a rampant month here in August. We're starting to roll over as things stand now. Let me show you on the weekly time frame. We can see that the long-term trend is certainly a bearish one, but more recently we've found ourselves almost within a range. You can see the bottom end here, sort of 0.577 up to 582, really capping price action over the course of the last sort of half a year. Now, the rally that we've just seen has taken us up through the first area of major resistance, which is 0.621. That's the peaks from sort of February into June. We still have above that this 0.636, 0.637 kind of level to watch out for. And certainly if we break through that level, that does point towards greater confidence of a bullish resurgence coming back into play here for the Kiwi dollar. On the 4-hour chart, we have broken down through, let me just get rid of that. We have just broken down through that first swing low here. Oh, we haven't actually broken it. Excuse me, 0.622. That's the first swing low to be looking out for, and that's pretty much where we are at the moment. And certainly if we break through that level, it points towards a possibility of a wider retracement coming into play. Quite how far that goes remains to be seen. But certainly this is a key level to be looking out for in the near term. And like I said, we are looking on that daily time frame like we could give some back, that big upper shadow here on the 29th of August. And so a lot of this will come down to what happens in terms of the jobs market in the US in a week that will really likely be dominated by Friday's unemployment rate and non-farm payrolls figure, but certainly starting to roll over a little bit, taking back some of the gains. And if we break through that 622 level, it could point towards a decent pullback coming into play here for the Kiwi dollar. But certainly there's a possibility that we're bottoming out here. And certainly as we move into a period that is likely to be dominated by monetary easing, most notably from the Fed, that could provide the basis for a move out of the dollar, and that US dollar weakness story could see not only the Kiwi against the US dollar bottoming out, but the potential for many of these different currency pairs featuring the US dollar to turn against the greenback. Now let's look at the indices space, and we can see here it is the Spanish IBEX that has found itself at the top of the pile, and at the bottom of it we have, let me just go, there you go, the Russell 2000. Now it's notable here that we've seen a relatively mixed bag when it comes to what's happened over in the US, and certainly the Russell 2000 finding itself at the bottom of the pile. Part of this is a sort of a kickback after a period where we'd seen this sort of catch-up play, and we'd seen the Russell 2000 really outperforming. Well, enter the beginning of this year, and certainly, of this month just gone, and we saw some significant concerns coming into play, most notably around that FOMC meeting and then the likes of the US jobs report. And so the question mark here is, are we entering a period that is going to be recessionary? Because as we're growing more confident about the idea that the Federal Reserve are going to be cutting interest rates, and therefore the cost of borrowing is lower, and therefore businesses within, say, the Russell 2000, many of which are not profitable and are reliant on borrowing, they will be able to borrow at a cheaper cost, and therefore it benefits that index in particular. Well, at the same time, if we saw the US economy going into recession, that is not good for businesses like that, and certainly funding would likely dry up at that point. People start feeling less confident and start tightening their purse strings, and also those businesses would likely suffer a drop off in demand in response. So the Russell 2000, you can see why that's happening. In terms of the Spanish index, well, that is sort of heading up a move within Europe, where we actually saw the European markets doing relatively well. There's greater confidence that we won't necessarily see a recession coming into play. Things are sort of heading in the right direction, and notably the ECB already has been cutting rates. There's an expectation that they will continue to cut rates, and inflation has been moving towards target, and that does provide greater confidence that we will see that move coming into play in the near term. Now, in terms of the chart, here is the, let me just take that off. Here we go. Here is the chart for the sort of Spain 35, essentially, as they call it. And so this is the weekly time frame, right? So I'm just showing you the wider context is very much a bullish one. You can see that we have sometimes protracted periods of retracement, sometimes protracted periods of sort of consolidation. But generally, certainly since this low that we've got here in October 2022, we've seen this sort of rally, the consolidation, rally, retracement, and now heading back into another rally once again. In terms of the fib retracements, you can see we've come into that nice deep retracement zone, and we've been heading higher ever since, week upon week, gaining ground. And certainly, you know, if you're comparing these markets and saying, well, look, it was this market that was the big outperformer, you have to also know how they've done the month before that, because you can see that really this is a catch-up play that we're looking up here, because we saw that sharp pullback into that deep retracement zone. It's not like we're looking at a rally that's built on strength in the prior month. So this is a case of really recovering that lost ground, and we've done that and some, rallying back up towards that peak that we have here. Let me just get a regular price on here. 11486 is the resistance level up ahead. The daily time frame shows you just how clear cut that rally has been. Whether we're going to see some sort of pullback, well, at the moment we're not necessarily seeing that. You can see that we've got sort of tentative signs of weakness with the touching of that 11337 level, but certainly we'd need to start breaking below that level and the 11308 level to point towards a retracement coming into play for this market. Until that happens, the bulls remain in charge. But like I said, up ahead we've got this essentially 115 handle, which is that prior peak that we have here. That is going to be the big resistance level up ahead that needs to be broken to continue on this recent vein. It's notable if we're looking at the relationship between the likes of the IBEX and the S&P 500. You can see that generally it's the European markets that underperform against the US markets. But actually, over the past 3 to 4 years, we've seen both markets sort of rotating between each other. So essentially we're seeing relative strength, I would say, and it's holding up relatively well against the US markets. So certainly there is the demand as things stand. And so, you know, generally in the past, it's just been a case of the US market is the only place to be. Certainly, this market has been faring very well against the S&P 500, and some people at the moment are perhaps sort of turning their eyes away from big tech and trying to find opportunities elsewhere. And part of that also is the Russell 2000, because if we're looking at this market, it certainly has been in this sort of pullback consolidation phase for an extended period of time. And then we've really seen it rekindled with this breakout through your sort of 2000 mark. And we've been regaining ground since then. Now, we saw this sharp decline, like I said, at the beginning of August, leading into an August that, again, much like the Spanish market, we have been just recovering lost ground, really trying to get back up to that 2300 mark that we saw prior to the month just gone. So this is a recovery play. It's heading higher once again. I would expect to see more of the same, really, as we try to recover, get back up to that peak and try to push onwards and upwards from there. Certainly the weekly time frame shows you that we're still some way away from that peak that we have up here at 2458. And I think there's a good chance we do get there, and some, certainly as we move into a period that is all about easing. It's all about expansionary monetary policy, recovery in terms of the growth perspectives. It looks good for markets like this, and therefore the recovery that we're seeing playing out at the moment, I wouldn't necessarily think this is just a precursor to us rolling over. I would think that there's a good chance that we do see the bulls coming back into play and pushing onwards and upwards from here on in. Then let's look finally at what's happening in terms of the commodity space. And you can see on the top end, we've got nat gas. And much like last month, I don't necessarily want to just talk about natural gas every month, because it's been devalued to such an extent that each month it feels like it's the biggest gainer or it's the biggest loser. So I'm going to focus on these two metals, and that is palladium and platinum. It's really interesting because they're both within the same family of metals, but one's at the top end, one's at the bottom end. And so it's a question mark of, why is that happening? But also, is this something that is indicative of potentially a catch-up play for one against the other? So this is the chart for, here we go, palladium, right? And so we can see here the long-term trend is very much a bearish one. And the story for these assets are very similar. We've got a demand destruction taking place as people move towards electric vehicles, catalytic converter demand falling off a cliff, or it's at least expected to fall off a cliff. And therefore, we're seeing that continued downtrend playing out. Now, on this occasion, we can see that we came into the month off the back of a sell-off. We did sell off a little bit more, but we recovered some from there. So let's just get this onto the regular pricing. So sold off a little bit, but then recovered, right? And so on the platinum side of things, we came into it, sold off, recovered, and then sold off once again. Now, the wider trend is not as bad here for platinum as it is for palladium. But nonetheless, we can see that we're rolling over once again, and we're seeing this creation of lower highs, lower lows. We did see this sort of flatlining high coming into play around here at 980, but platinum looking like it's breaking down once again. The 4-hour chart shows you that higher highs, higher lows, breaking through support here at 936, and now we're seeing lower highs, lower lows. So this is looking bearish for me. The platinum and palladium, we can see that arguably it has the more bearish chart of the two. And so the recovery we've seen at the moment, I think there's a good chance that we're just going to see it mimic what's happening in terms of platinum, in terms of that potential breakdown. And so unless we see a breakup through this near-term resistance 1055, then there's a good chance that the rally that we're seeing at the moment is going to be relatively short-lived in nature before the bears come back into play. You can see we've come back towards that 76.4 fib level, starting to pull back. Now, the key thing here is, do we break through the 939 level? A break below that level would give me greater confidence that we are going to see the bears back in charge for palladium. But I would say palladium and platinum, if you look at on the long term, they're not necessarily the kind of charts that I'm desperate to be long in. You would say more so with platinum, we do sort of base out around sort of 850, 875 kind of area. So there's some question marks around that. You could say that we're potentially creating this higher low here, but then we've essentially moved into this Fibonacci level at the moment, just moved a little bit beyond it and pushing upwards. So certainly if we break lower beyond that Fibonacci level, then, it really does test the question marks around whether you're going to see the bulls coming back into play once again here. Certainly, we've seen some weakness coming into play already for platinum. Palladium, I think there's a good chance we see a similar kind of thing playing out soon enough.